Hi traders, and welcome to the first basic course. If you are an advanced trader and you have already learned about Japanese candlesticks, you can skip this course. But if you are a beginner trader, watching this video is highly recommended. The first skill that you need to acquire to become a successful trader is the ability to read your charts. This ability will allow us to analyze financial markets and predict future price movement with high accuracy. When it comes to charts, there are three most popular types of charts: line chart, bar chart, and candlestick chart. Japanese candlesticks represent the best type of charts. It surpasses the line chart significantly, and it is just more visually pleasurable than the bar chart. Japanese candlestick is the language of financial market. If you can master this language, you will communicate better with your market. And this is what makes a difference between successful traders and unsuccessful traders. Successful traders communicate better with their market. Candlestick charts originated in Japan. This type of chart was created by Morihisa Homma, one of the best traders in history. Morihisa Homma was born in 1724 into a wealthy family. The Homma family was considered so wealthy that there was a saying at that time, "I will never become a Homma, but I would settle to be a local lord." When Morihisa Homma's father died, Morihisa was placed in charge of managing the family's assets. He went to Japan's largest rice exchange, the Dojima Rice Exchange in Osaka, and began trading rice futures. Homma kept records of yearly weather conditions in order to learn about the psychology of investors, and he set up his own trading system called Japanese candlesticks. This trading method allowed him to dominate the rice market. He was called God of Markets in his day, and he made a huge fortune. It was said he had 101 trades in a row and made more than 10 billions in today's dollar. Unfortunately, we cannot use the same method because current markets are not the same, but we still can use Japanese candlesticks in combination with other price action strategies to make our trading decisions. In fact, there are so many ways of using candlesticks, but in this video we will focus only on studying the anatomy of candlesticks and the psychology behind the formations. So before you can read the candlestick chart, you must understand the basic structure of a single candle. It's very important. Each candlestick accounts for a specified time period. It could be 1 minute, 60 minutes, daily or weekly. And regardless of the time period, a candlestick gives us four important information: the opening price at the beginning of the time period, the closing price at the end of the time period, and the highest price during the time period, and the lowest price during the time period. As you can see in this example, when you read a candle, depending on the opening and closing prices, it will provide you information on whether the session ended bullish or bearish. When the closing price is higher than the opening price, as you can see here, it is called bullish candlestick. By contrast, when the closing price is lower than the opening price, as you can see here, it is known as a bearish candlestick, and the upper and lower shadows of the candlestick represent the highest and lowest price during the time period. Now let's go through the specific candlestick patterns we look for. The first candlestick pattern we look for is the doji candlestick. The doji candlestick is a unique candle that reveals indecision in the market. Neither buyers nor sellers are in control. The doji candlestick is characterized by its cross shape. This happens when the market opens and closes at the same level, leaving a small or non-existing body. When this pattern happens in an uptrend, as you can see in this example, it could be viewed as an indecision that buying momentum is slowing down. So traders may view this as a sign to exit an existing long trade. The same thing when it occurs in a market that is trending down. As you can see in this example, the formation of the doji indicates that the downtrend is no longer strong, and this could be viewed as a sign to exit your trade. Remember, it is possible that the market was undecided for a brief period of time and then continued to advance in the direction of the trend. Therefore, it is crucial to conduct thorough analysis before exiting a position. Please focus right now on the psychology behind the doji formation. In the next lessons, I'll show you how you can use it as a basing candle and as an entry signal in combination with supply and demand strategy. Let's move to another Japanese candlestick pattern, which is the inside bar. So what is an inside bar? An inside bar pattern is a multi-bar pattern that consists of a mother bar, which is the first bar in the pattern, followed by the inside bar. As you can see in this example, inside bars can form exactly in the middle of the mother bar or close to either the high or low. There is not an exact way they have to look, just as long as they are contained within highs to low distance of the mother bar. In fact, an inside bar can have multiple inside bars within the mother bar, and they are considered inside bar patterns as well. An inside bar pattern represents a pause or a consolidation in the market. It is considered as a continuation signal in trending markets. When this pattern occurs in an uptrend market, for example, it offers a good opportunity to join the trend. Let me show you an example. As you can see here in this example, this is an uptrend. If you miss your entry here or here, the inside bar gives you another opportunity to join the trend after the breakout of the mother bar. As we said, the inside bar represents a pause or a consolidation, and the breakout of the mother bar means that the consolidation phase is over and the market is likely to go up again. Let me now show you another example of a downtrend market. As you can see, here there is an inside bar that was formed after the breakout of the support level that becomes resistance. If you miss this opportunity, the inside bar pattern gives you another opportunity to join the trend here and another opportunity here. Inside bars can represent reversal signals in ranging markets, but I'm not going to show you how you can trade it in different market conditions, because what matters now is to know the anatomy of the inside bar and the psychology behind its formation. The next candlestick pattern is the engulfing bar. The engulfing bar is formed by two candles. This pattern has a pretty easy to recognize structure. It consists of two candles. The first candle is totally engulfed by the next candle. In fact, there are two types of engulfing bars: bullish engulfing bar, as you can see here, and bearish engulfing bar, as you can see here. A bullish engulfing bar typically forms after an extended move down. It signals exhaustion in the market, where sellers begin to book profits and buyers begin to take interest, pushing prices higher. As you can see here in this illustration, the market was trending down. The formation of the bullish engulfing bar represents a reversal signal. That means that buyers engulfed sellers. In other words, buyers took control from sellers. Let me give you a real chart example. As you can see here in this chart, the market was trending down. That means sellers are in control of the market. The formation of the bullish engulfing bar indicates that sellers lost control of the market and buyers are stronger, so the market is likely to go up. So what about the bearish engulfing bar? A bearish engulfing bar pattern typically forms after an extended move up. It is a sign of exhaustion and a signal that a market may be in the early stages of reversing. Just as the name implies, an engulfing candle is one that completely engulfs the previous candle. In other words, the previous candle is completely contained within the engulfing candle's range. As you can see in this illustration, the engulfing candle's range, high to low, completely engulfs the previous candle. Let me show you a real chart example. As you can see in this chart, the market is trending up. The formation of the bearish engulfing indicates that buyers lost control and sellers may reverse the market direction. The engulfing candlestick setup has a strong reversal character. If the price is increasing and an engulfing bar is created on the way up, This gives us a signal that a top might be forming now. The opposite is enforced too. If the price is decreasing and an engulfing bar appears on the chart, this suggests that the price action might be forming a bottom. The next Japanese candlestick is the pin bar candlestick pattern. The pin bar should probably be called the king pin because it can be thought of as the king of price action setups for its ability to provide high probability entry points in trending markets, range-bound markets, and at K levels against the trend. A pin bar is one bar formation. The pin bar is a price bar which has rejected higher or lower prices. Price will open and move in one direction, and then reverse during the session to close at or past the open. The pin bar should have a long upper body or a lower tail. The tail is also sometimes called the wick or the shadow. In fact, they all mean the same things, but the longer the tail, the better. The area between the open and close of the pin bar is called the body or real body, and the end opposite the tail is sometimes referred to as the nose. The pin bar is a common reversal signal which typically needs to occur near a support or resistance area. I mean horizontal levels or dynamic moving averages. It can be used in conjunction with Fibonacci retracements as well. Let me show you an example. As you can see here in this example, the market is trending down, and after this retracement, prices formed a pin bar that was rejected from 50% Fibonacci levels. This Fibonacci level is very important, and when combining pin bars with 50% Fibonacci, we get a great result. Let me show you another example. As you can see here, the market broke the support level. This support becomes resistance. After this short retracement, the market formed a pin bar that indicates rejection. Here, as you can see, sellers rejected buyers when prices reached the support that becomes resistance. So this is a good opportunity to place a sell order. Look at another example. This is a range-bound market. In this type of market, we only trade from the boundaries. I mean from support and resistance, because buyers wait at the support level and sellers wait at the resistance level. As you can see, when the market reaches the support level, it forms a pin bar which indicates that sellers are rejected by buyers. So it is a strong signal to buy the market. And when the market reaches the resistance level, it forms another pin bar which indicates that buyers are rejected by sellers. And this represents a good opportunity to short the market. I'm not going to show you how to trade pin bars in different market conditions, because what matters for the moment is to get the ability to read the anatomy of pin bars and to understand the psychology behind its formation. In the next lessons, you will learn how to trade pin bars in combination with supply and demand areas.
Let's move to the morning star candlestick pattern. The morning star is a 3-candle reversal pattern occurring at market bottoms only. So it is a bullish reversal pattern. The first candle is bearish, continuing the trend in the downwards direction. The second candle will have a small body and the color is not important. The third candle is a bullish candle and penetrates well into the body of the first candle. The further the penetration, the better. So what does the morning star tell us when it occurs in a downtrend market? When the market is trending down, the formation of a long bearish candle confirms that the bears are continuing the downtrend. The second small body shows a possible loss of momentum. The third bullish candle indicates that bears are no more in control of the market, and the bulls will take control. When this pattern happens in a downtrend, it indicates a bullish reversal signal. Let's look at a real chart example. The market is trending down, showing that bears are in control of the market. The formation of the morning star pattern leads to reversal of the trend to the upwards direction. Remember, we don't trade candlestick pattern alone. We trade candlestick with other technical tools such as support and resistance, supply and demand, fiber levels, and so on. This is another example. As you can see, the market is trending down. Sellers are in charge of the market. The formation of the morning star leads to a trend reversal. The evening star is the opposite version of the morning star. It is a 3-candle reversal pattern occurring at market stops only. So it is a bearish reversal pattern. The first candle is bullish, continuing the trend in the upwards direction. The second candle is a small buy that shows a loss of momentum, and the third candle is bearish. The first candle of the evening star shows us that everything is looking really bullish at this stage. The second candle shows us a loss of momentum, and the third bearish candle shows us that sellers are now in control of the market. Let me show you an example. As you can see here, the market is trending up. Here buyers still control the market. The second candle shows indecision in the market, and the third candle shows that sellers took control, and the pattern indicates a bearish reversal signal. The evening and the morning stars are reversal patterns that can be used only at the end of an uptrend or a downtrend. They don't work in range-bound or choppy markets. Now let's move to another price action pattern, the piercing pattern. The piercing pattern is a 2-candle pattern occurring in market bottoms only, so it's a bullish reversal pattern. The price action leading up to a piercing pattern must be a downtrend. Ignore the pattern in a sideways trend or an uptrend. Price must be trending downwards. Let's talk about the anatomy of this candlestick pattern. As you can see, the first candle is bearish, continuing the trend in the downwards direction. The second candle is bullish, opening below the first candle, or even better, below the low of the first candle, then closes above the midway point of the first candle. In other words, above the 50% line here. Now let's consider the psychology or the sentiments of the piercing pattern. So who is in control of the market? Buyers or sellers? As you can see, the first candle continues the downtrend. Everything is looking bearish. The second candle opens below the low of the first one, so the bearish trend appears to be continuing again, and sellers are no longer willing to sell the market at these low prices. However, buyers find these low prices attractive and enter the market in more force. So the balance of supply and demand has been tipped now slightly more in favor of buyers, and price goes up. The key to this pattern is the movement of price above the 50% level here. This is considered the balance point for bullish and bearish sentiment. Buyers are able to push the price back up above the central balance point and close price in the upper area. This will shake the confidence of a number of sellers, leading them to exit their positions if the pattern is confirmed as price trades above the high of the second candle. And it will strengthen the confidence of a number of buyers who will enter and drive the bullish move upwards. Let me show you a real chart example. Here the market is going down. Right now sellers are in control of the market. Here the first candle confirms the selling pressure, but the formation of the second candle below the first one and the fact that it closed above the 50% level indicates that buyers are more stronger and they are going to take control of the market. As you can see, after the formation of the piercing pattern, the market goes up. This pattern works when it is used with other technical analysis, and we will use it with supply and demand strategy as an entry signal and as a basing candle. So the most important right now is to focus on the anatomy of this pattern, and in future lessons you will learn how to trade it successfully. Now let's move to the opposite version of the piercing pattern, which is the dark cloud cover. The dark cloud cover is a 2-candle pattern occurring at market tops only, so it's a bearish reversal pattern. The price action leading up to a dark cloud cover must be an uptrend. The pattern doesn't work in a sideways trend or a downtrend. Price must be trending upwards. The first candle has a bullish real body continuing the trend in the upwards direction, and the second candle is a bearish candle opening above the real body of the first candle. So price in the bullish candle here closes here and then open at a higher price here. It's better if the open gaps up above the high point or above the tip of the shadow here of the first bullish candle. The second candle closes down below the midway point of the bearish candle. As you can see here, the 50% line marks the midpoint between the open and the close of the bearish candle. The second candle must close below that point. Let's consider the psychology of the dark cloud cover. Who is in control of the market, buyers or sellers? The name of the pattern gives a good hint. What comes from dark clouds? Rain, right? And what does rain do? It falls. This is why it is considered a bearish reversal pattern. Anyway, let's consider the psychology or the sentiment. The first candle continues the uptrend. Right now, everything is looking bullish, as you can see here. The second candle opens above the high of the first bullish candle, and as a result, buyers are no longer willing to enter the market because prices are higher. So some of them may be taking profits and exiting their positions. However, sellers find these prices attractive and enter the market in more force. The balance of supply and demand has been tipped slightly more in favor of sellers and price falls. The key to this pattern is the extension of the down move below the 50% line of the first candle. This is considered the balance point for buyers and sellers. Sellers were able to push the price back down below the central balance point and close price in this lower area. This will shake the confidence of a number of buyers, leading them to exit their positions if the pattern is confirmed. And it will strengthen the confidence for a number of sellers who will enter to push the price back down. Let's look at this example. As you can see in this real chart, the market is trending up. Buyers are in control of the market. But when the market reaches this level, everything has completely changed and sellers push the market down. If you know about the dark cloud cover pattern, you will understand what happened. As you can see here, buyers are still in control of the market. But when prices opened above the first bullish candle, buyers are no more willing to buy the market from this area because prices are higher. But sellers find it a good opportunity to enter the market. So they pushed prices back down the 50% line of the first candle and closed below it. This indicates that sellers are more stronger than buyers and a bearish trend reversal is likely to happen. Now let's move to another candlestick pattern, which is the Mariposa. The Mariposa pattern is the opposite version of the doji candlestick pattern. If the doji candlestick pattern indicates indecision in the market, the Mariposa indicates buyers or sellers domination. So what does the word Mariposa mean? The word Mariposa means bald head or shaved head in Japanese. And this is reflected in the candlestick's lack of wicks. So when you see a Mariposa candlestick, the fact that there are no wicks tells you that the session opened at the high price of the day and closed at the low price of the day. The Mariposa candlestick pattern is one candle, easy to spot signal with a very clear meaning. There are two types of Mariposa. Bullish Mariposa that refers to bull's control of the market. In this case, the opening price is below the closing price, which indicates that buyers are in control of the market during all the trading session. The bearish Mariposa refers to bear's control of the market, and in this case, the opening price is above the closing price, which indicates that sellers are in control of the market during all the trading session. A Mariposa is a continuation and a reversal pattern. Depending on where a Mariposa is located and the type of the pattern, you can make your predictions. If a bullish Mariposa occurs at the end of a downtrend, a reversal is likely. Let me show you an example. As you can see here in this chart, the market was trending down. Sellers were in control of the market. The formation of the bullish Mariposa indicates that buyers are in control of the market during this trading session. So sellers are no more in control and a reversal is likely to happen. And as you can see, the market changed direction and went up. Let me show you another example. If a bullish Mariposa occurs at the end of an uptrend, a reversal is likely. Let's look at this chart example. As you can see, the market was trending up. This means that buyers are in control of the market. The formation of the Mariposa indicated that sellers are in control of the market during this period of time. So buyers are no more strong and the bearish reversal is likely to happen. And as you can see, after the formation of the bearish Mariposa, the market went down. When a bullish Mariposa occurs during an uptrend, it indicates a bullish trend continuation. And when a bearish Mariposa occurs during a downtrend, it indicates a bearish trend continuation. So that's all what we can see about the Mariposa candlestick pattern. You know, all the patterns that I mentioned in this video are important because we will use them either as basing candles to draw our supply and demand zone or as entry signals. But don't worry guys, because in the next lessons you will learn how to use them in combination with supply and demand strategy.